Hey guys, second video of the day because I've got nothing else to do. So excuse the wobbly camera, it's a bit of a dodgy road. But I just want to speak about inflation because something I always thought inflation was, right, is the inflation of price of goods. Let's speak about a Snickers bar, for example. You think of a Snickers bar back, if you're old enough, 15, 20 years ago. What was a Snickers bar 15, 20 years ago? 30p? 25p? 30p? Something like that. And what are they now if you go to a garage? Quid 10? Something like that. You might find one for 80, 90p if you're lucky. So the price of the goods increased, right? And you think, well, that's inflation. But it's not. That's not what inflation really means. You see, what happens is economies, countries need to show strength and power. So you got China that want to show their strong and power on the world stage. You got the USA want to show power and strength on the for America. So when you're looking at forex, foreign exchange, you see the prices of the dollar and the euro and the pound and the yen and the Australian. They're all moving around all over the place, and they're all trying to stay afloat and stay strong. But what happens is when there's a catastrophe or something bad happens, whether it's COVID, we go to war, there's fires, whatever it might be, any catastrophe that happens, the country, the government, give the bank of that country a license to print money. Not a physical printer that prints off sheets, but a literal license to print, and it's zeros. So you got the S&P 500 in America, you got the FTSE 100 in the UK, you got the Italy 40, I think Spain 40, and all the top companies of those countries. Now, to stay afloat, the banks give the countries, or I should say the countries give the banks license to print money to give to these companies. And what that does is that shows that the economy is strong. But the problem is, once that money has been created and given out, there has been an inflation of the amount of coins, pounds, euros, yen, US dollars. That's been inflated. Now, because the amount of coins that are in distribution, in circulation, that's inflated, therefore the value of that's been inflated. Let's say there's 10 Stratocaster guitars ever made. There was only ever 10. Well, those Fender Stratocaster guitars would be worth loads of money because there's only 10. But let's say Fender decided to make 200 million of those guitars. Well, all of a sudden they'd only be worth a couple hundred quid instead of thousands. Well, it's like that with pounds, yen, coins, and all the rest of it. The more they print, the more they give out to companies as stimulus money and money to make themselves look strong, the less it's worth. So when you go to the shop to buy your Snickers bar, the Snickers hasn't gone up in value or down in value. It's still a Snickers bar. It's only worth the what it does to your tummy, the energy that it gives you for that short period of time, or the fat that it puts in the belly, whichever way you want to look at it. But the point is because there's been an inflation of money, therefore the money has decreased in its value, and you need more coins to buy the Snickers bar. Yeah? So inflation isn't the inflation of the value of the good, it's inflation of the amount of coins that are in circulation, and therefore it requires more to buy the goods. Yeah, so I hope I explained that quite clearly. It's a simple thing, but unless you get your head around it that's the way around it, then that's kind of like the first steps of understanding the economy. Understanding the economy and how the world works when it comes to the government trying to help the country succeed and appear strong to the rest of the nation. All right, so all good. I have got to just pull over just here, and I will say goodbye.